So you've done the homework. You've read the books, you've watched the videos, you probably even have a spreadsheet. You know what you're supposed to do, but that little voice in the back of your head keeps asking, am I really ready for this? Well, in this explainer, we're going to shut that voice down for good and give you that final, confident push from just knowing things to actually doing them. Look, you've got the theory down pat. You understand things like asset allocation, diversification, the magic of compounding, all the big ideas. You are literally standing right at the starting line of your entire investing journey. But for some reason, you just can't take that first step. And this is always the hardest part, isn't it? It's where the rubber meets the road. That little buy button on the screen suddenly feels like the biggest decision in the world, because now there's real money on the line. All that theory suddenly feels, well, pretty abstract. So, how do we find the courage to finally click it? That's what we're here to do. Think of this as your final pre-flight checklist. We're going to break down those last few mental and mechanical hurdles into simple, totally doable steps so you can launch your investing journey with total confidence. Let's get into it. First up, the big one. This is the question everyone wrestles with. You've got a lump sum of cash, maybe from savings, an inheritance, whatever, and it's ready to go. The question is, do you cannonball into the pool all at once, or do you just kind of dip your toes in the water a little at a time? Well, you've got this battle raging in your head, right? On one shoulder, the math is whispering, go all in. The market tends to go up, so the sooner your money's working for you, the better. But on your other shoulder, your human brain is screaming, whoa, hold on, what if you invest every penny and the market decides to crash the very next day? And that's the absolute nightmare scenario, right? That single stroke of terrible timing. The fear of that happening could trigger a crazy powerful psychological bias called loss aversion, where the pain of a loss feels twice as bad as the joy of a gain. It could scare you away from investing for good, and avoiding that outcome is way more important than chasing a tiny potential extra return. So here is the clear, simple answer. For new investors, dollar cost averaging is absolutely the way to go. Think of it like training wheels for your portfolio. It lets you get used to the normal ups and downs of the market without putting everything on the line at once. It turns volatility from something to be feared into just a normal Tuesday. All right, strategy chosen, you're ready to go. But wait, before you pull that trigger, we need to talk about a silent killer that could be lurking inside your investments, ready to eat away at your returns for decades without you even noticing. And that killer is fees. 1%. It really doesn't sound like much, does it? I mean, it's just a single penny out of every dollar. But in the world of investing where your money is compounding over decades, that tiny 1% is an absolute monster. Let me show you exactly what I mean. Okay, take a look at this chart. Now, just zero in on that high-cost investor down at the bottom, the one paying that 1% fee. Over 20 years, that supposedly small fee didn't just cost them a little bit. It has cost them over $43,000 in lost growth. That is a new car. That's a huge chunk of money just gone. So what's the big takeaway here? It's really simple. Fees matter. A lot. This isn't about picking winning stocks or timing the market. This is a guaranteed drag on your performance that you have total control over. And that is why you absolutely must build your portfolio on a foundation of low-cost index funds. Every fraction of a percent you save on fees is another dollar that stays in your pocket working for you. Okay, we are so close. You've got the strategy, you've got the right kind of funds in mind, but before you step into the real arena, it's time for a little sparring session. We're going to get you completely comfortable with the mechanics of investing before you risk a single real dollar. And this is your secret weapon. A stock market simulator is basically a video game for investors. It gives you a pile of fake money and lets you practice the real motions of buying and selling until you're a pro. Now, the goal here isn't to become a virtual millionaire. The goal is to make the process feel so boring and routine that when you do it for real, it's just second nature. All right, the time has come, the moment of truth. You've practiced, you're confident, you're ready. It's time to make your first real trade. But first, we just need to decode a couple last-minute bits of jargon you're going to see. First up is the ticker symbol. It sounds technical, but it's just a nickname for a stock or a fund. If you want to buy a fund that tracks the whole U.S. stock market, you'd type in VTI. For international stocks, you'd use VXUS. For bonds, BND. See? It's just a simple shortcut. Next, when you go to buy, you'll be asked to choose an order type. Again, sounds way more complicated than it is. A market order is basically you saying, hey, just buy it for me right now at whatever the current price is, get it done. A limit order is you saying, I will only buy this if I can get it for this specific price or less. So which one should you pick? Look, for a long-term buy and hold investor, the market order is the simplest and best choice, hands down. You're in this for decades, so trying to save a few pennies on the share price today is completely missing the forest for the trees. The most important thing is just getting your money in the market so it can start working for you. And click. You did it. You are officially an investor. Congratulations. So, what happens now? Well, you have a new job. But don't worry, it's super easy. You pretty much only have to do it once a year, and it's designed to keep your whole plan on track and automatically force you to make smart moves. So let's say this is your game plan. Based on your goals and risk tolerance, you decided on a portfolio that's 90% stocks and 10% bonds. This is your target, your North Star. It's the allocation you always want to come back to. But of course, the market has its own plans. After a year where stocks did really well and bonds kind of stayed flat, your portfolio has drifted. It's no longer 90-10. It's become 95% stocks and 5% bonds. That's actually a lot riskier than what you originally signed up for. But the fix is incredibly simple. It's a process called rebalancing. All you do is sell a little bit of your winners, in this case the stocks that went up, and you use that cash to buy more of the asset that underperformed, in this case the bonds. It's like a built-in buy low, sell high machine that forces you to be disciplined without letting any emotions get in the way. It's one of the true secrets to long-term success. And that's it. You've done it. You have designed and built a solid, low-cost, long-term investment machine. The hard part is actually over. Now comes the really hard part, doing nothing. Can you master the art of leaving it alone? Can you resist the temptation to tinker with it, to react to scary headlines? Can you trust the system you've built and just let it work? That is the final test of a true investor.